In order to begin to understand how our financial system works, we need to go back to the early 1900s, 1910 to be exact. Everyone at some point in their lives has heard of the Federal Reserve, but most likely don't understand what it is or how it works. The Federal Reserve, referred to as the Fed, is a central bank that many economists refer to as the biggest robbery ever enacted on the American people. The reason for this is because the Federal Reserve is neither part of the federal government nor does it have any reserves. Yet, this single organization controls the money supply of the most powerful country in the world. The Fed is very diligent in hiding the fact that they are not part of the government. The last thing they want the American people to fully understand is that our government does not control our own money. In order to achieve this, they were very clever and decided to call their institution the Federal Reserve. And by labeling themselves this way, the general public never thought twice about who was in control of the country's money supply. If the Federal Reserve is not part of the government, then who controls this private organization and how did this come to be? The answer to this question is what changed the course of our country forever. In November of 1910, a secret meeting took place of 6 bankers and economic policymakers who represented the financial elite of the Western world. It was hosted at the J.P. Morgan estate on Jekyll Island in Georgia. In attendance was Senator Nelson W. Aldrich, Abram Piatt Andrew Jr., Assistant Secretary of the Treasury, Frank Vanderlip, President of National City Bank of New York, Henry P. Davidson, Senior Partner of J.P. Morgan and Company, Charles D. Norton, President of First National Bank of New York, Paul Warburg, Director of Wells Fargo, Benjamin Strong, the emissary for J.P. Morgan, and coincidentally, the first president of the Federal Reserve. Years later, Frank Vanderlip referred to this meeting as the actual conception of what eventually became the Federal Reserve System. This meeting was so secret at the time that not even the names of those who attended were mentioned to the servants who lived and worked on the island. The men who attended came on a late-night train, claiming to be on their way to a hunting expedition, but instead, these bankers met with Senator Nelson Aldrich to draft what would eventually become the Federal Reserve Act. This private meeting, attended by some of the most powerful men in America, was strategically designed to take control of our country's money supply and to achieve ultimate power in America. Bayer Amschad Rothschild, one of the most powerful European bankers of his time, stated it best when he said, "Permit me to issue and control the money of the nation, and I care not who makes its laws." On December 23, 1913, 2 days before Christmas, when most people in Congress were home with their families, the Federal Reserve Act was signed into law by President Woodrow Wilson. That single act, however small it may seem, transferred the control of our monetary system from our government into the hands of some of the wealthiest men in our country. Putting into law the Federal Reserve Act gave unlimited power to a few wealthy banking institutions in America. The Fed has the power to issue currency, manipulate interest rates, and run secret bailouts. Yet Congress and the President are not allowed full oversight over this powerful organization. The Federal Reserve enjoys a monopoly over the creation of our nation's money and credit, but for 100 years, they have never been completely transparent and accountable about it. And we don't have to look back too far from today to see what it looks like in real life. When testifying before Congress in 2009, Fed Chairman Ben Bernanke refused to disclose which institutions received trillions of dollars in these bailouts and loans, or give our representatives details about what deals were being made.
So my question to you is, will you tell the American people to whom you lent $2.2 trillion of their dollars? Will you tell us who got that money and what the terms are of those agreements?
Hundreds and hundreds of banks, any bank or that has access to the U.S. Federal Reserve's discount.
Will you tell us who they are?
No.
In an interview with Treasury Secretary Timothy Geithner, he makes the stunning assertion that conducting a full audit of the Federal Reserve, something never before done in its 100-year history, is a line that we don't want to cross. To be denied full transparency of these transactions after U.S. taxpayers contributed over $16 trillion to these bailouts and loans is unthinkable and unconstitutional. It is our right as American citizens to know where our money is being spent. It's very ironic that if you don't give the IRS full transparency with your finances, you go to jail. But if you're a private organization of elite bankers that controls the money supply of a country, you're free to do as you please without full oversight. This private organization is arrogant in the fact that the same accounting laws that apply to the rest of America do not apply to them.
There is no other agency of government which can overrule actions that we take.
Their control appears to be unlimited, and 2008 is the most recent example of how much power the Fed actually has on our country.
Many of us were told in private conversations that if we voted against this bill on Monday, that the sky would fall, the market would drop 2,000 or 3,000 points the first day, another couple thousand the second day, and a few members were even told that there would be martial law in America if we voted no. That's what I call fear-mongering.
The elite banking institutions took trillions of dollars worth of risk, and when they lost their bets, they threatened politicians to use taxpayer money to bail them out, or else we would face an Armageddon type of scenario. This historic change of power in America is again why many economists refer to it as the biggest robbery ever enacted on the American people.
The Federal Reserve System virtually controls the nation's monetary system. Yet it is accountable to no one. It has no budget, it is subject to no audit, and no congressional committee knows of or can truly supervise its operations. These are the words of the late Professor Murray N. Rothbard, economist and academic vice president of the Ludwig von Mises Institute. The Institute is dedicated to the ideals of a free market and sound money. This program is dedicated to the memory of Murray N. Rothbard and his prolific work on money and banking. For more than 20 years, the living standards of middle-class Americans have steadily declined. Incomes have remained flat or fallen, and the opportunities and security we once took for granted have begun to fade. For most families, one income no longer pays the bills. It requires two or more incomes to afford a home, pay medical and child care expenses, and put children through school. Unless present trends change, young workers are unlikely to ever live as well as their parents. Good jobs with a future are harder to come by. Education doesn't count for what it once did. Taxes continue to rise, while Social Security is going bankrupt. Private pensions are no longer reliable. Economic volatility and uncertainty are on the rise. Politicians espouse numerous theories about the cause of this country's economic woes. Seldom, however, do these officials look below the surface. The roots of our economic ills can be traced to central banking and our present monetary system. The Federal Reserve claims to manage our money. Instead, it makes our money worth less and less every day. It has generated continuous and worsening business cycles and lowered our living standards.
It's really no different from a burglar in your house wanting to steal your money. That's what the Federal Reserve does. It depreciates your savings, it takes away your economic security, and it ought to be treated as an institution that does that rather than something of alleged benefit.
Money is supposed to serve as a reliable standard of economic value, not a source of instability. Until we restore sound money and take away the government's ability to debase it, we have little hope of restoring the freedom and prosperity that made America great.
And we really have a choice of what we want in money. Do we want money that's going to be losing its value every year, or do we want money that's going to be gaining in value? If you are happy with your money losing value, then you want the present system. If you want money to increase in value, then you want a gold standard.
What is money? As the good that makes exchange possible, it's the foundation of every economic activity. In the earliest times, people traded goods and services directly. This form of exchange is known as barter.
That is, if a fishing tribe desired to have maybe wheat, which they themselves did not produce, they would seek out other individuals that produced wheat, and then they would exchange their fish.
But barter had limitations in the marketplace.
Well, actually, people perceived pretty quickly problems with that direct exchange. If you wanted, for example, fish, and you had wheat, but the people who had fish didn't desire the wheat, you were stuck, okay? Unless you went out and found some other good, possibly berries, that everyone in that society consumed. Then you would trade your wheat for the berries in full confidence then that you could turn around and trade the berries for the fish or anything else that you desired.
Eventually, the most widely accepted goods in a society became valued for their use in indirect exchange. Money is simply another name for the most generally accepted medium of exchange. Throughout history, many goods have served as money. Feathers from the Quetzal bird were used for exchange by the Mayan Indians up to the 15th century in Central America. Tea leaves compressed into bricks were traded in East Asia through the 1800s. Wampum shells were money to North American Indians, while early American colonists traded beaver pelts, which had a high value both at home and abroad. Metal coins first emerged in Greece and Asia Minor during the 7th century BC. Gold and silver were valued for their use in beauty and jewelry and the decorative arts. They were durable, easily divisible, and limited in supply. These precious metals also had a high value-to-weight ratio, making them easily transportable.
You might think back, or we can think back to a time when iron was used as money, for example, in Africa. But imagine going into Sears Roebuck and trying to purchase, let's say, a lawnmower for $350. That would take a ton of iron, whereas it would only take an ounce of gold.
In 1536, less than 50 years after Christopher Columbus set foot on American soil, a Spanish mint in Mexico City struck the first coins made in the New World. These silver coins eventually found their way into the British colonies. Great Britain's mercantilist policies deliberately tried to keep precious metals out of America, so the Spanish milled dollar became the unofficial currency. It was often divided into 8 pieces for smaller transactions, hence the term pieces of 8, with 1/4 of the coin being 2 bits. In 1792, Thomas Jefferson adopted the dollar as this country's official monetary unit.
He looked around, he investigated to see what were the American people using as money, and that was the dollar. And so that's why that dollar became the standard of the United States. And we went onto a gold and silver standard and started minting gold coins with the American Eagle, a $10 gold coin.
Jefferson, in particular, spoke eloquently of the dangers of paper money. During the War for Independence, the Continental Congress printed vast sums of paper money out of thin air to finance the Army. The diluted money supply naturally depreciated to almost nothing, leading to the phrase, "not worth a Continental."
And the people who held on to these notes, who tended to be patriotic Americans, concerned about wanted America to be free of British control, lost everything. Whereas the Tories, who wanted nothing to do with this American government money and immediately got rid of it, were benefited And Pelatiah Webster, the first American economist, and others who looked at this saw that this paper money unbacked by gold was extremely dangerous.
As early as the 16th century in Europe, goldsmiths stored gold coins for their customers for a fee and issued receipts for the gold to the depositor. Thus began the use of paper as money.
In other words, if you came in and deposited 10 ounces of gold for safekeeping, you got back receipts in the amount of 10 gold ounces. Okay. And those receipts entitled you to instantaneously redeem that gold.
These receipts soon became widely accepted as a means of exchange, since it was easier and safer to use the receipts for significant transactions. This was the origin of banknotes as money substitutes. These first bankers then took this process one step further.
In effect, if the goldsmith had 1,000 ounces of gold and 1,000 ounces of legitimate receipts being held by the depositor of that gold, he could increase his profits by merely printing up another 1,000 ounces worth of receipts and lending them out. Okay. In which case you would effectively get 50% reserve banking or fractional reserve banking. Only a fraction, 50% of the receipts were now backed by gold.
There was no longer a 1-to-1 ratio of paper to gold. Now there could be 3 or 4 pieces of paper in circulation for every unit of gold in the vault. These bankers were no longer simply storing or warehousing gold for a fee. They were artificially inflating the money supply and loaning out these phony receipts at interest. This system became known as fractional reserve banking and was later transported to the early American colonies. It formed the root of American commercial banking and ultimately the Federal Reserve System.
This is a fraudulent system. It's not allowed in any other business. If you had a grain warehouse that had loaned out the grain it was supposed to have in storage, that's considered criminal. The guy would go to jail. But the banks are the one industry that's allowed to get away with this and to profit from it.
Alexander Hamilton became the first Treasury Secretary, and in 1791 set up the first Bank of the United States as America's central bank to expand the supply of paper money for the benefit of the government and the commercial banks.
Alexander Hamilton believed in a strong central government, and he saw a central bank as one of the means by which the government could be centralized and by which its power could be expressed.
Thomas Jefferson opposed this view. He saw a central bank as an undemocratic tool of the northeastern banking establishment. It was dismantled after 20 years.
Jefferson was an opponent of a strong central government and at all costs wanted to remove the central bank.
In 1816, the federal government made another attempt to set up an inflationary central bank. But this second Bank of the United States was denounced by President Andrew Jackson as a monster bank for benefiting a few at the expense of many.
They inflated the money supply, which brought about a boom initially, that is prosperity to the country, followed by a bust. When they stopped inflating the money supply, many businesses that had depended on the low interest rates that were introduced or induced by the initial inflation went out of business.
Jackson succeeded in abolishing the second central bank in 1836. But by then, speculators had set up hundreds of new private banks with little or no gold to back the notes they issued. The nation's monetary system became more stable when the United States introduced a gold standard in 1834. The dollar was worth approximately 1/20th of an ounce of gold.
The gold standard was understood by the Founding Fathers, by Andrew Jackson and others, as being a money of the people. That is, it was a hard money, a money that could not be tampered with, that could not be inflated to permit government expenditures skyrocketing.
But by 1862, Abraham Lincoln needed to fund his invasion of the South. So once again, the government began to print up paper money.
Basically, the United States went off the gold standard in order to finance the Civil War. Okay, and you'll find in history that almost every large war, every major war, has involved a departure from the gold standard, because the gold standard puts strict limits on government financing.
Lincoln's notes became known as greenbacks because they were printed in green ink rather than the usual black ink on the reverse side. These so-called fiat notes were deemed legal tender by the government, but they were not redeemable in gold.
Lincoln, under cover of war, issued tremendous numbers of greenbacks. Gold was still circulating, but people were forced to accept these greenbacks as if they were at par with gold.
The government's power to print unbacked paper notes would later become the pillar of the Federal Reserve System. After the Civil War, the nation's monetary system became sounder when the U.S. adopted a gold standard.
We went back on the gold standard in 1879 and had probably the greatest period of growth and of prosperity ever in the country's history.
For nearly 20 years, the total output of goods and services grew at an unprecedented rate of 4% per year.
The reason being that with a sound money and without the ability to manipulate the interest rate, we had a lot of genuine saving and investment, which then led to more capital goods and higher labor productivity in the United States.
In the midst of this prosperity, the big industrialists and financiers were plotting to expand their empires with the help of government. With the passage of the Interstate Commerce Act of 1887, the large railroads succeeded in blocking their smaller competitors through regulation.
The ICC was put in place in order to protect the railroad owners from competition. Okay? It was not the case that it was going to protect consumers or shippers. In fact, consumers were hurt because ultimately, with higher railroad rates, they were forced to pay higher prices for the goods and services that were shipped across the country.
By 1896, they were poised to do the same thing with the banks. Two camps emerged as leaders in this economic war. They were led by J.P. Morgan, the world's most powerful private banker, and John D. Rockefeller, the oil tycoon. Morgan and Rockefeller were great adversaries, but despite their business differences, they both favored a central bank. They wanted cheap credit and an inflated money supply to finance the expansion of their empires. Together, they led the campaign to sell the idea to the American public, which later led to the founding of the Federal Reserve.
If the American people got wind of the fact that this bank was not in their interests, in fact, they understood that it was in the interests of the financial elites who would use it to inflate the money supply and in doing so increase their own revenues, they would have been held to pay. The legislation would have never passed under those conditions. So it had to be sold to the American people as a way of making their currency more elastic.
The bank reform campaign received a boost in 1907 when there was a run on some of New York's biggest banks thanks to their fractional reserves. Panic spread among depositors who got wind of the bank's insolvency and tried to withdraw their money. The Knickerbocker Trust failed, and two other institutions went to the brink of bankruptcy despite a $35 million bailout from J.P. Morgan. Wall Street swiftly adopted the fear of bank failures to sell the idea of a central bank, or lender of last resort, to the American public.
And so the Federal Reserve was to be the lender of last resort. In case any bank got into trouble, they wouldn't have to worry. They'd get the cash from Washington, D.C.
The question is, however, whether it is really desirable to have such a thing as a lender of last resort. The correct position appears to me that every single bank should be responsible for its own debts and contractual obligations. And if banks, through imprudent policy, then go bankrupt, this should not be considered a bad thing, but in fact considered to be a magnificent thing, because bankruptcies, the danger of bankruptcies is precisely what makes banks adhere to sound policies.
Bank runs and failures continued at an alarming rate. In 1908, the National Monetary Commission, headed by John D. Rockefeller Jr.'s father-in-law, Senator Nelson Aldrich, was set up to push for a central bank. In November of 1910, under the guise of a duck hunting trip, 6 men took a secret train ride to an exclusive private club on Jekyll Island, Georgia, to write a central banking act. The classified gathering read like a who's who of American banking. There were 2 Rockefeller men, Aldrich and Frank Vanderlip of the National City Bank of New York, 2 Morgan men, Henry P. Davidson from Morgan Bank and Charles D. Norton, president of Morgan's First National Bank of New York, Paul Warburg, a Kuhn Loeb partner, and Assistant Treasury Secretary A.P. Andrew, who was friendly to both camps. They spent a week at the luxurious club as Morgan's guests, crafting the proposals that would form the basis of the Federal Reserve System. It would be 3 years before their vision was realized. Just before Christmas 1913, the Federal Reserve Act was passed by Congress and signed by President Wilson. It established a Federal Reserve System to oversee monetary policy and regulate the commercial banks.
It's no coincidence that the Federal Reserve System was established by the Wilson administration. This was the height of the Progressive era, a time of tremendous government expansion and of special interest deals in Washington.
There are 12 regional reserve banks concentrated in the East and the Midwest. The Board of Governors of the Federal Reserve controls and coordinates their activities. The board is made up of 7 members appointed by the president. Even though there were 12 regional banks, Wall Street soon ran the show. As president of the New York Fed, Morgan protege Benjamin Strong seized control of the board's Open Market Committee operations. Strong would remain the dominant force at the Fed until his death in 1928. The Federal Open Market Committee, now based in Washington, directs the Fed's most important instrument of monetary policy, the purchase and sale of government securities on the open market. To increase the supply of money and credit, that is, to inflate, the Fed buys government securities from a few hand-picked firms with newly created money. To tighten money and credit, the Fed sells securities. In this, it can act on its own discretion.
Every government wants the ability to create new money. Okay? It's an alternative to raising taxes. Taxes, as we said, when they're raised, tend to evoke a lot of resistance among the public. It's much less painless to increase the money supply. The effects, the negative effects, don't occur until 6 months, a year, 2 years later, at which time the increasing prices can be blamed on other factors, the weather, speculators, and so on.
Another device the Fed uses to control the amount of money in circulation is setting the discount rate. This is the interest rate charged to member banks when they borrow short-term from the so-called discount window. If the Fed lowers the discount rate for its loans, commercial banks will likely borrow more from the Fed. This increases the amount of funds banks have to lend. Bank credit thus becomes cheaper, as reflected in lower interest rates on bank loans and credit cards. The increase in funds available for banks to lend also increases the amount of money in the economy. The Fed can also manipulate the nation's money supply by raising or lowering the reserve requirement. Banks are required to set aside a percentage of their deposits as reserves to meet depositors' demands. When the Fed was established in 1913, it cut reserve requirements in half over the next 4 years, doubling the money supply by the end of World War I. But the Fed's real power lies in its monopoly to create money. Although the U.S. was still on the gold standard in 1913, it was quickly eroded as the Fed continued to expand the money supply. The first step was backing Federal Reserve notes by only 40% in gold. allowing the money supply to be increased 2.5 times. The inflationary effect of fractional reserve banking was also heightened by the central bank.
The commercial banks are permitted to create checkbook money on top of Federal Reserve notes. That is to say, the commercial banks are only obliged by law to hold reserves in the form of Federal Reserve notes of 10% to back all demand deposits that they have. 90% of their demand deposits are backed by nothing.
The Federal Reserve System adds another inflationary layer to an already unstable banking system. For example, if the central bank has $100 worth of gold reserves in its vaults and a 10% reserve requirement, it can print up $1,000 of new notes and deposits, which become the reserves of the commercial banks. The commercial banks take this $1,000, and if they're required to hold 10% again in reserve, they can multiply the $1,000 into $10,000 through fractional reserve loans. So an inverted pyramid is created with $100 worth of gold or real money at the bottom and $10,000 of inflated paper money at the top. As this $10,000 in new paper money circulates in the economy, it drives prices up, therefore reducing the buying power of ordinary citizens.
When they spend that money, the people who get the new money first and are able to buy products with it benefit, and the people who get it at the end lose, because when they go to spend it, prices have already gone up, and so they're able to buy less. And so there's a transfer of wealth and of power from some segments of the economy to others because of the actions of the central bank. And basically those who benefit are the government itself, big banks, and government contractors, and anybody who's closely associated with the federal government.
By making enormous amounts of credit easily available, the Fed can also drive down interest rates, sending out the wrong signal to investors. It sets in motion an unsustainable investment boom that carries with it the seeds of its own destruction. It's this business cycle that is ultimately responsible for economic disasters such as the Great Depression. Soon after the Federal Reserve was established, the U.S. entered World War I. Once again, the government temporarily abandoned the gold standard to print more money to finance the war effort. The U.S. government borrowed heavily, and the national debt ballooned from $1 billion to $27 billion. A sharp spike of inflation followed. This set off a cycle of rapid expansion and contraction in the economy. To dampen the overheated economy, the Fed halted its inflation, causing interest rates to nearly double over the next 18 months. By 1921, the market began to recover. New technology helped to increase productivity. Markets developed for new cars and appliances. The 1920s were a period